Hi everyone, hope you all are doing well and welcome to my first long form YouTube video. As I'd promised that once we hit 100 subscribers on YouTube, I'd be releasing this video. And I couldn't really think of a better topic than to talk about my own portfolio and the key stocks in my portfolio. Do note that none of this is investment advice. You should rely upon your own research before taking any such investing decisions. And also that I'm not a SEBI Registered Investment Advisor. The purpose of this video is just for me to share my portfolio and tell you guys a little bit about it, the reasons why I bought these stocks and so forth. Do not rely on this. This is no advice. Okay. That said, let's get right to it. These 5 stocks that I'm going to be talking about account for nearly 95 to maybe even 98% of my total portfolio value. I'm a firm believer of having concentrated portfolio of businesses that you truly understand. And it's not just me, it's also Warren Buffett.
I think that diversification is a terrible mistake. If you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need.
So that said, let's get right to it. The first stock is HDFC Bank. I've personally always liked HDFC Bank purely because of the rate of growth, the quality of their assets, and how conservative the management historically has been with regards to growth. They've not tried growing too fast at the expense of quality, both in terms of deposits and in terms of their loan book. So that is something I've always liked about HDFC Bank. But I only bought the stock recently because while I always liked the stock, I never liked the valuation at which it was trading. But post their Q3 results this year, the valuation I felt had become attractive. Now, a lot of you might say that the stock fell a lot because of the merger and the NIMs have fallen. NIMs, just for your information, are net interest margin. Net interest margins are basically the spread between what you pay, say, to the deposit holders and what interest rate you charge to the people you give out loans to. In January, the stock fell a lot, if I'm not wrong, right around 15% or so from their highs. This is exactly when I entered the stock because I always believed that it is a great stock, as I had just discussed. But now it was also available at a fairly decent valuation. So why did I buy it when everybody else was sort of more inclined towards selling it? It's purely because the NIMs, which have been a major issue for the bank, I believe are going to improve over time. HDFC was a housing finance company, right? And housing in general has lower interest rates than, say, corporate loans or car loans or so forth. Further, housing NBFCs really depend a lot upon bonds to fund these loans. They can't really have deposits of their own, which is why they're reliant upon bonds, and bonds tend to have a higher cost of capital, right? Bonds are costlier to own. Like for the bonds, they had to pay 7, 8, 9% sometimes. Whereas in the case of HDFC Bank, they were reliant upon deposits. Now, this is the biggest synergy that HDFC Bank is going to enjoy. Other than that, Keki Mistry, actually, the chairman of HDFC, if I'm not wrong, also talked about the fact that 70% of HDFC's customers are not HDFC Bank's customers and vice versa. So when this collaboration actually happens and after this merger, as we have already seen, I really feel a lot of these synergies are going to kick in, and as a result of it, it's really going to be beneficial for the total stock, the overall stock. So that is the reason I'm bullish on HDFC Bank. The next stock in the list is UPL. UPL, as you may or may not know, is the largest agrochemicals player in the country. This primarily includes herbicides, pesticides, and seeds. Now, the reason why I bought the stock is purely because of valuations. Now, while UPL is the largest agrochemical company in the country, it is also, if I'm not wrong, the cheapest. It was trading right around book value after their Q3 results. And this is when I thought that it was time to jump in because agrochemical industry is very cyclical in nature. For those of you who don't know what cyclical in nature means, it's basically like this, right? What does that mean? That they're going to have good times, they're going to have bad times. Currently, the agrochemical industry is facing a bad time, which is precisely why you're able to buy a company like UPL at such a discount. In fact, in terms of book value, its price to book value is cheaper than what it was even during COVID. If I'm not wrong, it was trading right around 1.2 times its book value during COVID. Currently, it's trading right around 1. Not currently, but at the time when I bought it, it was trading right around 1. Next stock in the list is Aditya Birla Fashion. This stock has been in the news lately primarily because of the news around its demerger. But before getting into any of that, let me talk about the brands that they own. Louis Philippe, Peter England, Alan Solly, Van Heusen, Pantaloon, House of Masaba, Sabyasachi, And then here are the brands that they have rights to sell in India: American Eagle, Hackett London, Fred Perry, Simon Carter, and Reebok. Let's have a very quick look at their numbers and that of its competitor, which is Tata's Trent. Trent reported a revenue of around 3,500 crores last quarter, whereas Aditya Birla Fashion reported a revenue of a little over 4,000 crores. At the same time, Trent trades at a market capitalization of 1.5 lakh crores, whereas Aditya Birla Fashion, even after the recent rally, trades at 27,000 crores. Now, you might say that while Trent is really profitable, Aditya Birla Fashion is not. And absolutely that is true, but part of the reason why this is the case is because of their high amortization costs. A quick note: if you don't know what amortization is, you should have a look at this video and you'll know exactly what I'm talking about. Now, back to it. A large part of their high amortization cost is actually merger and acquisitions that the company has been involved in. And because of these high amortization costs, the company actually reported a loss over the last few quarters. I do have a feeling that over the next 1 or 2 quarters, they will be profitable other than that. So this is the reason why I own Aditya Birla Fashion. The next stock in our list actually deserves some respect because its new name is going to be Samman Capital. I'm talking about India Bulls Housing Finance. Now, why I own this stock? Purely because of valuations. India Bulls Housing Finance is trading at 60% or so of its book value. And this is at a time when some of its peers are trading at 2 or even 3x multiples to their book value. India Bulls Housing Finance has had a lot of problems over the last 5 years or so with regards to corporate governance and their older asset book, which is primarily their older loan book. Their old business has an ROA, which is return on asset, of 1.5%, whereas the new businesses that they are involved in today have an ROA of right about 3.5%. Now, they've really been trying to wind down their old business, so over time, this new business ROA is going to be reflected in their total AUM. And their AUM is basically asset under management. Their net AUM today sits at about 70,000 crores. Now, if you assume that over time their AUM is going to pick up and their eventual ROA comes to about 3%, then we're talking about profits of right around 2,100 crores. The last but not the least is Paytm. And I know probably a lot of you are going to boo me over this because the stock has not been performing great lately. I actually started buying it in December 2022 and I was very, very, very bullish on the company. At one point in time, this stock alone made up 95% of my portfolio, and I'm talking about a leveraged portfolio. So in terms of net worth, this one stock was right around 150% of my net worth. And I held a lot of stock. Like, I had gone totally gung-ho about Paytm. And if it wasn't for RBI action, I still believe that Paytm would have reported profitability in Q4, including the UPI incentives. And I really thought that if Paytm were to turn profitable in Q4, then the stock would have gone to the moon. But obviously it didn't happen. I still feel that despite the RBI action, the company is going to become profitable. Not in Q4 obviously, but say, maybe a few quarters down the line, maybe a few years down the line, which is why I continue to hold the stock. Not even remotely as much as I did back in the days, but I've still held on to a few thousand shares. And yeah, that's about Paytm. Anyways, guys, I hope you found this useful. These were largely the 5 stocks in my portfolio. Do let me know your thoughts on the same. And if you found it useful, even remotely, please hit the like button and do subscribe to this channel. It really means a lot.